independent insurance agent as well as real estate and private lender. My husband and I have been doing private lending and real estate investing for about 10 years now. We also have online our partners, James and Regina Cooper. So, they'll be talking a little bit later on and hopefully helping us answer some questions. So let's go ahead and get started. All right, so first and foremost, we're going to share a little bit more about who we are and what we do. And here at First Financial Security, we inform, educate, and empower individuals, families, entrepreneurs, and business owners about this next generation financial technology that we're going to be talking about tonight. And we do that so that everyone can achieve their financial security and long-term financial growth. And specifically, we educate people on how to protect their savings from losses while still providing for upside potential. We teach them how to put compound interest to work for you, not against you. We teach individuals how to maximize the use of tax-advantaged savings and lifetime income, and how to redirect funds that they're already spending to gain better value for their money. And so these are the four pillars of education that we predominantly focus on. So let's talk about this a little bit from a real estate investor and private lender perspective. What are the primary sources of funds that we as investors basically look for? There's the infamous OPM, otherwise known as other people's money. Where do we get that from? Friends and family, private lenders, such as what Ken and I do, hard money lenders and institutional private lenders, bank or portfolio lenders. There's also what we call personal vaults, or our own personal funds that we use for various forms of investing. That can be in the form of cash, self-directed IRAs, and as we all know, there's two flavors of that, traditional or Roth. There's also various new elements, or relatively new elements, solo 401ks, both Roth and traditional versions now if you own your own business. There's simple 403b, etc. And so there's lots of different options out there, particularly if you own your own business. So the question that we pose in this conversation is there another vault from which you can hold your funds and do your investing? And of course, the answer is yes. Otherwise, we wouldn't be having a webinar tonight. So now, the question that we posed, probably at, I don't know, some RIA event or some type of a various event where we might have met you, is how can you as an investor make money on your money while still using your money to invest or lend in real estate? And the answer is by placing your money in this new type of vault. The features of this vault are a vault with guaranteed no losses, and yes, we can legally say that because it is an insurance product, and we'll go over that a little bit more. And where you can become your own bank. And the other major feature of this vault is that you can use your own funds for whatever you want. For down payments, rehab funds, private lending, buy a new car, college education, it does not matter. There are no restrictions. So these are the three major features of this new vault. Let's look at the private lending example. So on the previous slide, we said that as being your own bank, you can borrow up to 90% of your cash value inside of the account. So let's say right now that you have a $100,000 account value. You can borrow up to 90%, which would be $90,000, at approximately bank-like rates, which right now is running about 5%. It depends a little bit on the carrier and the specific product that you have. And as private lenders, if we borrow from ourselves and our own bank at bank-like rates at 5%, and then we turn around and we lend the funds at, say, 12% with 3 points, then we use the proceeds of basically the loan proceeds that are coming back to us to pay back our own bank as if we were borrowing from anyone else. We make a spread of approximately 7% as cash flow, and we pocket the 3 points as income. The catch here is, you could do this out of a self-directed IRA, out of a savings account. You could do that part of it out of anything. The trick here is that the way we borrow the money out of the account allows us to still make our interest income that's indexed to the upside potential of the stock market, and we'll talk a little bit more about that later, but we still earn interest on the full 100K while we're lending out 90K of that 100K. And that is the beauty of the type of personal vault that we're talking about here, is you can earn money on your money in the form of interest while still using your money to, in this example, private lend and earn an income. Now let's talk about a rehab example. 100K account value, again, borrow 90K, same interest rate, exact same borrowing scheme. The awesome part about this is you get to fund the project however makes sense. You get, and again, once you complete your rehab, you can pay yourself. You pay the account back, and pocket the profits. The thing I want to highlight for rehabbers in particular is that this is a tax-free loan in the form of becoming your own bank. You can do as much work as you want on your project. Unlike funding a rehab through a self-directed IRA, where you're limited on the amount of work that you can actually do yourself on the project, it's kind of a gray area in self-directed IRA rulings. There's also no arm's length transaction. So if you wanted to lend money to your daughter, your parents, whoever, you want to use it for a vacation home. That's an infamous one that people want to do in self-directed IRAs, and they have no ability to do within self-directed IRAs because of the arm's length transactions. And the other beautiful thing is that while using this type of strategy, there's also no risk of quote-unquote blowing up your IRA if you were to accidentally violate any of those arm's length transaction rules. And so as savvy investors, we really want to know what we're getting into. We want to know, what the rules are. And, my husband and I still have self-directed IRAs. We'll always have self-directed IRAs, but we also own other types of vaults that give us other types of opportunities in terms of moving forward inside of the market. All right, so next question we generally get is how do I fund my account? So let's talk a little bit about that, and we'll get into the details of the accounts a little bit later. But I want to kind of get into the major questions that we're frequently asked. So let's say I do have a self-directed Roth IRA, and I've put in 100K in direct contributions to date. So that means that $100,000 is post-tax, i.e., we've already paid taxes on it, and I rolled it over into my self-directed Roth IRA. So this does not include any earnings on that 100K. So if, let's say that I did 2 fix and flips and I've earned 25K above and beyond that. So my total account value in my self-directed IRA is $125, but I started with $100,000 of post-tax dollars. We want to focus on that. Let's take an example of a 35-year-old female who qualifies under the insurance rules. And we basically ran an illustration where she took $20K per year for 5 years and moved it over into this specially structured cash value life insurance policy. And the specific illustration we'll be showing you today is with Life 360. It is an exclusive product, and we'll talk about why that's important later on, that is offered by Anico for FFS. And what's really important to understand is not anyone can help you do this. George Antone writes in the Banker's Code, which many of you may have seen us talk about or reference in our meetings, on page 119. Most insurance agents are not familiar with how to set up everything correctly. There is a lot to know in setting this up and teaching people how to basically become their own bank properly. You need a knowledgeable licensed agent. And that is what we are bringing to you as investors and as people who are knowledgeable about investing, as well as being independent insurance agents. We want to make sure that you're getting set up properly to create your own personal banking system. And if you're interested in learning more or reading the Bankers Code, we do actually have a link here where you can download a electronic version of the Bankers Code for free. It's http:// the letter M for impactwealth.com / bankers-code-book-free/. You do have to get on George's mailing list to download it, but he sends out some great information, so you can do that if you wish. But most important thing is you can't just run off and ask anybody to help you with this. Most licensed insurance agents don't understand how to help you with this. Now let's move on to the details. So we talked about the female, 35 years old, basically moving $20K per year over up to the age of 40. So that's 5 years that she's putting in $20,000, moving it from that self-directed IRA, post-tax Roth, self-directed IRA, post-tax dollars into this account. What that will get her is $885,000 worth of death benefit in terms of protecting her and her family and her loved ones if something were to happen to her in terms she passes away. And assuming that she pays herself back as she goes, and she or she never touches it, and she just lets it accumulate. If the stock market and the indexing continues to perform on average the way it has for the last 30 years, she would end up with $168,000 in annual income for 54 years after age 68. And the other part I want to talk about, because this is part of the exclusivity with Anaco, is in addition to getting the death benefit, which is a huge advantage over, say, like a self-directed IRA. In a self-directed IRA, if your money's out, your money's out. And it's not, there's no additional layers of protection. There's no additional benefits to your family. But there's also this other benefit, which is a living benefit. So in addition to protecting your family if something were to happen to you in death, if you become chronically, critically, or terminally ill, then you also have protections while you're still alive. And this chart over here, I won't go through all of it, but it shows you basically the amounts that you would have available to you if you were to become chronically, critically, or terminally ill while you have this policy. And if you want more details on that, we can walk that through with you individually as we move forward. Let me see if there are any questions so far from the group. If you do have questions, make sure you type them in the chat window or in the questions window. All right, it looks like there aren't any questions so far. All right, so what are we basing all of these numbers off of? So we talked about earning your interest rate, right, while you're still using your money. And where are those interest rates calculated from? So in this particular illustration, and we'll show you how they're decided a little later on, we're talking about a premium outlay of $20,000 per year for 5 years for a total premium outlay of $100,000. We're talking about a weighted average interest rate that varies over time, and the reason is because it's a 30-year look back. The indexing strategy, the interest strategy, is basically using 30 years of the S&P 500 performance to basically determine what the interest rate is for any given year in the account. And you can see your cash accumulation value, assuming those interest rates continue, assuming the 30-year look back continues, is basically looking at the first year you would have $18,000 out of the 20 that you put in to borrow or lend against. You have $37,000, $58,000, $82,000. And actually, by the 5th year that you're actually making the deposit, you will have already surpassed the total amount of premium outlay that you have you're putting into the account in your cash accumulation value. And so it's just can be, and you're getting all these other extra benefits, to protect yourself and your family, as well as potentially produce a retirement income for you long term. So we just wanted to demonstrate some of the numbers because frequently we're asked questions about that. Now let's talk about How is this possible? Sounds too good to be true. How is this possible? Well, this new personal vault, generally speaking, we have two places we can put our money. Fixed products, which we know are CDs, money market, mutual funds, savings accounts. The challenge with them is they have a very low rate of return. The benefit to them is they have the safety of principal. They have guaranteed no losses. On the flip side of that, we have investing, and we have variable products. The great side of those is that they have the upside potential that we're looking for in terms of how we grow our money. The downside is that we essentially have to risk our principal in order to get that upside potential. The phenomenal thing, there is a product in the middle. It's called an indexed product, and it combines the safety of principal with the upside potential of the stock market. And exactly what does that look like? So here, this chart should look very familiar to everyone. This is the S&P 500. There's $100,000 invested in the S&P 500 from 1997 to 2012, and the 2014 chart looks very similar to this. And so we essentially are moving people from the red line to the blue line. And what does that really mean? On the red line, you're going up really high, but then you crash down, and you have negative. You basically feel the full impact of the negative performance of the stock market, and then you climb back up, and you get back to break even, and then you get dragged back down again. The difference is on the blue line, which is where the index products reside. You may not get all of the gains of the S&P 500 in the up years, but the trick is 0 is your hero. Whenever you have down years or the S&P 500 loses money, you get locked in. You're guaranteed never to lose any money out of your account whenever the S&P 500 goes down. And then whenever it starts going back up, you pick back up again. You won't get all the gains, but you'll get most of the gains, and then you flatline whenever the losses are there. And so which line makes you feel more safe based upon this performance through 2012? So what are the other key features of this product? So right now we've been talking about an IRA product or someone who's putting money into a 401k IRA. So the product that we're talking about actually, in addition to reducing your market risk and protecting you from protecting your family for death with the death benefit, as well as yourself from illness or disability, it also has huge tax advantages whenever you structure it properly. This is why it's so important to work with someone who knows what they're doing, because if you violate how to fund the account or how to take money out of the account, there are tax consequences. But whenever you work with us, and whenever we'll educate you on exactly how we can fund these accounts to basically maximize your tax advantages, and we'll talk a little bit more about that in a moment. It skips probate. There are no probate taxes. Basically, this money goes directly to your heirs as it happens. It also protects you from creditors. Yes, creditors. So essentially, this type of account is not something which creditors can go after if you were ever in a situation where that. And so what we call these little blue bubbles is the storm cloud to life. And so what we're trying to help educate people about how to do is take their hard-earned money and put it into a home, a vault, called an indexed life account, where basically you're protected from all these storm clouds in life. I'll go over these one more time just to summarize them. Key features of an indexed universal life account is cash value accumulation, which is what we talked about in terms of the interest rate with the 30-year look back. And that cash value is accessible via tax-free loans. You have index crediting strategies. And with the Life 360, which I illustrated with our example, it is 100% participation, and it has an uncapped strategy, which means basically the upside potential of the S&P 500 indexing strategy is unlimited. And the other thing to note is that there are guaranteed minimum returns, just like with whole life, and they're comparable to whole life policies. But again, you have the potential for the upside, but you do still have minimum guaranteed returns across the life of the policy as well. Living benefits we talked about, this is a no-cost rider. So the combination, whenever we talk about exclusivity with FFS of the Anico product, the exclusivity is the combination of this uncapped indexing strategy with a no-cost living benefits rider. You can find each of these features in various policies out there in the insurance universe. But together, it is this product is currently exclusive. That combination of features is currently exclusive to First Financial Security in the Life 360 product. And again, this is a phenomenal product if you become chronically, critically, or terminally ill, and we can send you videos that basically help demonstrate the power of having this type of account to lean on if something were to happen in your life. Permanent death benefit, we've talked about before. This is an asset, independent of your employer. I know most everyone who has a W-2 job, you know, they do have life insurance, but it's term insurance and it's provided by the employer. And yes, it's inexpensive, and I would never discourage anyone from getting it. However, when you leave your employer, you no longer have it. And it's just something that people really need to start thinking about a little bit more. And it essentially gives you this asset, protects your family, and allows you to leave a legacy. So let's talk on the positive side. So let's assume nothing happens to you, and you live this really long and healthy life, and you've borrowed money and paid it back. You've been a disciplined banker and borrower from your own bank, and now you're ready to retire. You're ready to kick back and see what happens. Through the same mechanism that you funded your investing through tax-free loans, you can essentially get that income year after year after year without putting in additional money into the account. Now, if you were undisciplined as a borrower and you didn't pay your account back, then basically there would obviously be less funds to draw on during retirement. So that's why being a disciplined borrower, whether it's with your own bank or with any other bank, is critically important as you move forward as an investor. Oh, the other thing I want to talk about is, as we all know, an insurance policy is only as good as the company that issues it. And I want to talk with you a little bit about Anico and National Life Group, our two flagship carriers. They are both over 100 years old. To the best of my knowledge, National Life Group is a mutual company, so it's highly important to you to have, to be a part of a mutual company where you're part owner of the company by owning your Index Universal Life policy. That is available. Anico is a publicly traded company, but it is very closely held within the Moody company, and the family is still basically in control of, if I remember correctly, somewhere around 69% of the stock. So they have the luxury of being able to take a longer-term look at investing and how they manage their finances. They are both rated both in all of the ratings. I believe one is an A and one is an A+, but you're going to be very, very happy with the carriers. And even though they may not be household names, they're some of the best insurance companies out there on the market. All right, let me see if there's any questions before we move on. I don't see any. Okay. All right, so let's talk a little bit more about how money works. And again, as sophisticated investors, most of us probably know this, but I do want to cover it just in case. The question we always ask is, what do you want to pay taxes on? You want to pay taxes on the seed or on the harvest? So, and the reason we ask that question is this. In the United States, there are three major categories of tax advantage. There's tax-deductible contributions, tax-deferred accumulation, and tax-free distribution. The trick is we can only get 2 of the 3. Otherwise, we get things like platinum bracelets, orange jumpsuits, and new neighbors, in the form of tax evasion. So with your 401ks, your 403bs, your traditional IRAs, anything which is considered a pre-tax retirement account, you're basically taking advantage of the first 2, tax-deductible contribution and tax-deferred accumulation. So tax-deductible contributions means I'm going to put my money in now, and Uncle Sam's going to basically not make me pay taxes on that money until sometime later when I take it out. Tax-deferred accumulation is actually in both the traditional and the Roth. So both types of accounts have tax-deferred accumulation. So that means as I gain, I make a really great real estate investment and I make $12,000 in my self-directed IRA. That $12,000 I don't pay taxes on until I take it out. Now, in the Roth, where I'm fronting the money, or the money I'm depositing into my Roth account is post-tax dollars, right? Then I've already paid my taxes on it. I can't pay taxes twice on the same money. Then I actually get not just tax-deferred accumulation, but also tax-free distribution. And so those are 2 critical elements to understand about the difference between traditional and Roth. So one of the questions that we have for you is, have you considered your options? We're going to walk through a little example here. This is the tale of 2 brothers. Again, we have a 35-year-old. In this case, they're married with 2 children. Both are saving the same amount of money, earning the same 8% interest rate for the same period of time. Now, this illustration assumes a fixed 8% growth rate in all accounts. So, and we just want to compare apples to apples. So we went ahead and make that assumption, even though we know that in most accounts that's an unrealistic assumption. So, Brother A believes in the old way. He's going to make his $6,520 contributions into the 401k that's provided by his employer. His employer is very generous. They're going to match that $1,050. And then his employer is putting forth one of those term policies that we talked about. It's a fantastic, it's $600,000, and all he has to pay is $680 a year in premium. Brother B says, well, wait a minute, I've heard about this thing called Index Universal Life. I've kind of looked at it. It seems like it works for me. So he's actually decided to stop contributing the $6,520 into his 401k, and he's also decided to stop paying on that $600,000 term policy and take that $7,200 and put it towards an annual premium on a $600,000 life savings account. So they both have $600,000 worth of coverage at this point in time, one through a 30-year term, one through an Index Universal Life savings account. But they're getting it in very different ways. So let's fast forward in time. After 30 years, Brother A is like, all right, man, I've saved $858,000 in my 401k. Time for me to retire. Well, now that he's retired, again, we talked about this earlier, he no longer works for that employer. To replace that $600,000 term insurance policy on his own in the open market is going to be a $12,000 annual premium to replace it. But, man, he got those tax savings. He's in that traditional account. He has those tax savings. He saved $65,000 cumulatively over those 30 years in taxes. Brother B, on the other hand, well, the cash value in his life savings account's only $709,000, so I'm not so sure he did as well on the saving part. But look at this. His life savings account death benefit is now $864,000. So he still has protection for his family. But you know what? This was all post-tax dollars. He paid those taxes up front, so he had no cumulative tax savings. So basically, he has a total of $709,000 for total retirement savings. But as we all know as investors, it's not how much you make, It's how much to keep. So fast forward. During retirement, Brother B, through tax-free loans that we discussed earlier, is going to be able to take out $97,000 a year. Assuming Brother B dies at age 100, he will have received $3,395,000 as income, as tax-free loans via the life savings account, and will have still left his family over $3 million in death benefit. Whereas Brother A, for him to get the same $97,000 in annual income, he has to withdraw about $130,000 a year, because he still has to pay taxes on that money. And this is assuming the tax rate doesn't change. This is assuming the exact same tax rate for all 30 years. And how many of us believe we're going to be paying the same tax rates in 30 years? I'm not sure I do. But let's look at this number. In the first year of his withdrawal, he's paying $32,000 in taxes. So let me think back to the previous slide, though. How much total tax savings did he have over 30 years of depositing into the 401k? Wasn't that something like $65,000? So in 2 years, he has already paid back in taxes everything that he saved by using Uncle Sam's traditional IRA or traditional retirement savings plan strategy. Unfortunately for Brother A, and unfortunately for many, many people who are in the U.S. right now, this is exactly what's happening. They did what they were told to do. They followed the instructions. They saved all their money in traditional 401ks, and now, they're taking their income out, and in 9 years, at age 74, Brother A runs out of money and has to go back to work. All right, let's click over here, see if there are any questions. All right, I don't see any questions. I don't see anything in the chat window. So I hope you guys are figuring out that it really does matter where we put our money and how we think about our money, and really truly matters, not just for ourselves, but for the legacy we can leave behind. All right, so what's next? All right, so far we've been talking about what we call new money, or money that's in, say, like a Roth self-directed IRA that we can convert over, money we've already paid taxes on. Let's say that I do have a 401k and I'm retiring, and I want to protect at least some of it. Maybe I want to use half of it for real estate investing, but I do want to do an index strategy, this index growth strategy for at least some of it. And so we actually have another category of products. It's called an indexed annuity, and it's really for true retirement savings, things which are already in the taxation system. So as we all know, there's 401ks, IRAs, TSPs. We've been talking about that. What are the 4 major questions that most Americans have about their retirement savings is: don't lose my money, no loss of principal. In almost all options of 401ks, IRAs, TSPs, we have upside potential, but we also have downside risk, be that in investing, be that through buying gold, whatever we invest in inside of our self-directed IRAs, we almost always have upside potential and downside risk. Certainly in our 401ks and any type of T. Rowe Price or traditional brokerage funds, we're actually investing in the stock market. So with the indexed annuity, we already talked about indexing strategy. Same thing applies here. No loss of principal, guaranteed no losses. So again, 0 is our hero. Now, the second one is, how much income will I have to retire on? So let's go into an example. Let's say I have $100,000 in a 401k. If I were to move that over into my new retirement savings vehicle, my indexed annuity, I get a 10% bonus on day 1. So on day 1, I get $110K. And I get up to 21% interest rate. There's several different index annuities out there with different ranges, but for right now, they're illustrating it up to 21% rate of return in terms of your indexing strategy. The other huge benefit with one of our flagship products, and not all of them have it, is a guaranteed lifetime income rider. And yes, I said lifetime income benefit. And the interest rate, the guaranteed interest rate on that ranges between 4 and 7%, depending upon your age and which options you select. But what that does is if you select, whenever you have that lifetime income benefit rider, it will take the maximum of the guaranteed rate of return that you signed up for, be it between 4 and 7%, again, depending upon what you choose, and the amount of money that was accumulated in your account through the indexing strategy, which in this case we're illustrating as $200K on the left-hand side. And let's say that whenever we ran it forward, it was $100K on your guaranteed lifetime income rider. And now you're ready to say, okay, I want to exercise my guaranteed lifetime income rider. The product will take the maximum of the $200K and the $180K, and will base your guaranteed lifetime income upon the higher of those two values. So in this case, we're going to assume that the indexing strategy did better than the guaranteed rate of return of 4 to 7%. And the reason is because we still want it with the old IRA or TSP to be relevant here. So will I run out? And just like in the Brother A, Brother B example, let's say you've talked to your accountant, you've paid off your mortgage, the kids are through school, and you've talked to everybody, and all you need out of this account is $20K per year. Well, in the traditional IRA, if you have $20K per, or even in a self-directed IRA, if you're taking out $20K per year and you have $200K, you have 10, maybe depending upon the performance of the funds, maybe 12%, 12 years worth of income. On the other hand, you could get approximately $20K out of your indexed annuity for the rest of your life, and that's what they call the guaranteed lifetime income rider. It's a calculation which will determine exactly how much you're going to get for the rest of your life, regardless of how long you live. Then there's another question, like we talked about in the life insurance side, is what happens if I have a catastrophic event? There is also something called a well-being rider. So ultimately, if you can no longer perform 2 of the 6 primary life functions, this is the same definition of disability that exists with Social Security, but if you end up in that situation, the insurance company is going to say, I'm sorry, I can no longer pay you the $20K per year. We're going to double it for 5 years. And the reason they do this is because most long-term care situations in the United States run about 3.5 years in duration. And so they made it a 5-year benefit because they wanted to make sure that they covered at least 2/3 of the statistical duration, the duration of at least 2/3 of the long-term care outcomes in the United States, and that's where they got the 5 years duration from. And then, oh, by the way, after you exercise that well-being rider, you go back to earning your fixed income per year again for the rest of your life as long as you live. All right. So, any questions so far? Okay. All right. So just wanted to share with everyone that there are also, if you look on your little panel, there are some handouts, and I believe there are 4 handouts that you should be able to download. So make sure that you look in your little webinar panel, and you feel free to download those. All right. So let's talk a little bit about procrastination. If you know if you are 25, or if you know any 25-year-olds who just graduated from college, it's critically important that they need that they understand that in order to have $1 million at age 65, a 25-year-old needs to save consistently a little less than $300 a month. Now, once we get to 35, that number jumps to almost $700 a month. It over doubles. Once we get to age 45, we do still have some time, but it's pretty painful. We're now looking at about $1,700 a month to accumulate $1 million in 20 years. By age 55, most people are just kind of hoping something comes their way, because they have to put away over $5,000 a month in order to reach that $1 million mark by age 65 in 10 years. And what's really interesting in the United States is so many people seem to forget that it's impossible to save money when you're not making money. And so if you wait until you're retired to focus on your retirement, then it's impossible to save when you have no income. But the beautiful thing about this and about our conversation tonight is that it all is not lost, because let's say that we are in this situation, that someone out there is in this situation, and maybe they have not been successful in putting away what they need to live comfortably for the rest of their lives. So you have the opportunity to become our business partner and discover a great encore career. And so we're very excited to be able to offer and bring people onto our team and help educate them about how they can go out into the community, make a difference in other people's lives while making a difference in their own financial future as well. All right, so any questions on what we've talked about so far? All right, seems like we're good. So let's talk a little bit about the opportunity. So we offer a risk-free opportunity. There's no major investment, no franchise fees, no loss of job security. Nobody can fire you other than you. We actually prefer people who do not have experience in our industry. We prefer people who come to us with other types of life experience. There's no inventory to buy. There's unlimited territory and unlimited opportunity. Many people focus on this as a part-time second income earner. Basically, they still have a full-time job, or they have something they love to do, and they're just looking to augment their income, possibly to allow a spouse to stay home and take care of the kids. You can be a personal producer, which means that you just basically focus on building your client base, or you can actually build a business and build a team as well. What we love about this business is that you're in business for yourself but not by yourself, and that's demonstrated with the partnership that my husband and I have, not just amongst ourselves but amongst James and Regina Cooper, who are online as well. So I wanted to kind of ask James and Regina if they had anything to add for tonight's presentation, or if they had any specific questions or thought of anything that I hadn't covered.
Thank you for the opportunity to talk to everyone. This is James. I just wanted to say that this is many times we experience or see something, and the first thing is, because we've never had knowledge of it, we can't believe it's true. And not only is this true, but many people are leveraging this to help finance their dreams and their goals for their future. So if you are a person that wants to have the gains that you can achieve in the market while having no risk of losing your money, which you can in the market, then this is an opportunity that you need to take a long look at. And we are more than willing to assist Judy in her mission of bringing this out to the savvy investors in the real estate market and helping you all understand how you can leverage your money and reduce or eliminate your exposure.
And as always, Judy, you did a great job. I just want to say, for those that are listening, if you have any questions, this is something that's, the information's out there. You know, by all means, go out and do your research. Ask, follow up with us, and we'll get the information you need to know if you need more information. And just really look into the information, because like James said, it's something that A lot of people don't know this out there and didn't know that was available. So knowledge is power, and that's basically what we're doing, is putting the power in your hands to make a better decision, make better choices for what you want to do, and to achieve your goals. So thank you.
Thank you.
Awesome. Thanks, guys. Okay, I'm going to pick on a couple of attendees. Miss Linda Franz, I see you're online tonight. Anything you want to share with the group?
No, I think that the more that people learn about this product, the more possibilities and potential they see in the products and in the opportunity. And it's just, it's a phenomenal tool, and it's a phenomenal business opportunity. And
Thank you so much.
Great.
Awesome. Mr. Gray, Robert Gray, I see that you're online. I know that I think you joined us a little late. I just wanted to check in with you, see if you had any questions, or share maybe the thing you found most exciting about what you heard tonight. Okay, I think maybe, Robert, if you're talking, I think you're on mute. All right, seems like we may not be able to hear from Robert. Miss Gina Mills, are you still on?
I'm here.
Hey, lady, how are you?
I'm well. How about yourself?
I'm exceptional. So, do you want to share any thoughts that you have on what you heard tonight, or any questions you have?
I don't. It's just that it seems like every time I listen to it, I pick up more and more. Excellent presentation, and I want to thank you for allowing me to sit in.
All right. All right. All right. Well, I definitely want to respect everyone's time, and let me check one more time to see if anybody typed in any questions in the chat window. Can't believe there aren't any questions. It's a fairly complex topic, so hopefully we did a pretty good job tonight in explaining it. If there are no more questions, then please do reach out to us. The Power of And at ffs-agent.com is the email address, and James, Regina, or I will get back with you. Again, thank you so much for your time and energy tonight, and we look forward to hearing back from you and hopefully continuing to educate you on the possibilities of what these products can do as a new personal vault for your investing. Have a great evening.